Hi folks, welcome to this video that reviews the kinds of costs that get included in inventory. So our problem below here asks that you identify if each item below should be included in the December 31st, 2017 ending inventory balance or not. We want you also to calculate what should be the ending inventory balance on the company's books, company being Solero, at December 31st, 2017. So now here's what we have in our problem. It says in an annual audit of Solero, you find that the physical inventory count at the end of 2017 had merchandise inventory at 441,000. Now, that may or may not be right. You have to look at all of these items here, we have several of them, and you have to determine, because they were excluded from ending inventory, so they weren't in this 441,000, you need to determine what the ending inventory balance should be if any of these items should in fact be included in the ending inventory. So all these items that follow here were not in this 441,000, but we want you to determine what that ending balance should be if in fact any of these items we're going to review should be in the ending inventory balance. So let's begin. First of all, you have merchandise of 61,000 that's being held by Solero on consignment from Bonbon. Well, first of all, if it's consignment inventory and it belongs to Bonbon, that means Solero is only holding it until they sell it on Bonbon's behalf. But that inventory belongs to Bonbon. So therefore, this would be properly excluded from this 441,000. So we're not going to include it. So far, we're at 441,000. The second thing that happened that the auditors found is that merchandise costing $33,000 was shipped by Solero, and it was shipped FOB destination. Now you remember what that means. If it's shipped FOB destination, it means it doesn't become the buyer's until it reaches their destination. So in our case, it didn't reach XYZ until January the 6th. So that means at December 31st, 2017, that merchandise still belonged to Solero. So therefore, it needs to be included in the ending inventory of Solero. So this item, it's in red for a reason, because it's going to be added to this 441,000 in order to determine what should be the ending balance of the ending inventory. Now, let's have a look at this third item. It says we have merchandise costing $46,000, and that was shipped FOB shipping point to ABC Company at December 29th, 2017. So what does that mean? Well, when it's shipped FOB shipping point, that means it becomes the buyer's once it leaves that shipping point of the sellers, right? So that happened on December the 29th. So that means that as of that date that it was shipped, it became ABC's. So therefore, it was not and should not be included in Solero's ending inventory. So we don't need to do anything there. Because don't forget, title to the goods passes when they leave the seller, because it's shipped FOB shipping point, and that's when it leaves the seller. So therefore, it belongs to ABC. So therefore, they didn't include it in the ending inventory, and nor should they. So now what about item 4? It says with item 4, merchandise costing $73,000 was shipped FOB destination from Wholesaler Inc. to Solero on December 30th, 2017. Solero received the items on January the 3rd. Well, don't forget, it said here they were shipped FOB destination. So what does that mean? It means that they become Solero's when they get them, which is January the 3rd. Well, guess what? That's before January 3rd is after December 31st. So since Solero hasn't received them yet, because the shipping terms, FOB destination, they should not be included in that 441,000 or over and above it. So therefore, since Solero doesn't have them, it should not be included in the ending inventory. And the company didn't include it in that 441,000, so they're good to go. What about this item here? It says merchandise costing $51,000 was shipped by a company called Distributor, FOB shipping point, on December 30th to Solero. And it reached Solero on January 2nd. But guess what? if they shipped at FOB shipping point to Solero on that date, then as of the date that it got shipped, it should be in Solero's ending inventory. So this item, again another item in red, needs to be added to that 441,000 in order to get the ending inventory amount. Let's look at our other items here. It says here, Solero had excess inventory and incurred an additional $1,500 in storage costs due to delayed shipment in transaction 3 above. Well, in transaction 3 above, we can see here that Solero shipped to ABC. So it could be, for whatever reason, there would have been a reason why maybe they couldn't ship it right away. They had to hang on to it. Maybe ABC wasn't ready to accept it, whatever the reason, right? But they can't add that to the cost of the inventory. What they have to do is expense it right away. It's a storage cost or a storage expense. Okay, it gets expensed directly to income, right? The only time you can capitalize and include in the cost of your ending inventory any storage costs is if you're incurring those storage costs because you have a prolonged production period, like the winemaking process that we talked about. So whenever you have an extended production process and maybe your product has to go from raw material to work in process to finished goods, and that takes an extended period of time to do it, like a long time to do it, then maybe we can justify capitalizing storage costs. But there's no indication that happened here, so those costs would need to be expensed and not be included as part of the ending inventory. So they were correctly excluded from the ending inventory. Now let's look at the other item. The last item here was interest expense on inventory it purchased through delayed payment plans. Well, if Solero bought some inventory and they didn't pay for it right away and the seller charged them interest, you don't capitalize that under IFRS. You don't capitalize that into inventory. That's interest expense, right? So that gets expensed directly to income. So it doesn't get capitalized or included in the cost of ending inventory. So in our case now, what we do, if that was the initial value of our ending inventory, 441, and items 2 and 5 we determined needed to be added in. Remember, item 5 was here, item 2 was here, right? Therefore, our ending inventory should be 525,000. So that's what should be reported on Solero's balance sheet. Now, if Solero was a private company, it's not, but if it was a private company, under ASPE, a private company has a choice. They can choose to record the interest on that's related to inventory. They can choose to capitalize it or not. But what they do need to do is disclose what they're doing, if they're capitalizing it or if they're expensing it. Now, that's their choice. But most companies following ASPE, most of them tend to follow the IFRS rule, which basically says most of those financing costs, because they wouldn't normally under ASPE, most companies would expense any kind of financing costs. We tend to find that under ASPE, most companies would not inventory any of those interest costs. They can, because under the ASPE rules, they're allowed to. But all I'm saying here is that most companies that are following private enterprise standards don't capitalize them or include them as part of the inventoriable product costs. They would normally just expense them. So anyway, I hope this video has helped you to understand a little bit more about the costs that get included in your ending inventory balances. Hope you enjoyed the video.